Good morning and welcome. My name's Caroline Hudd, and I'm your host this morning for the ING Economic Update. We have 4 insightful updates from our research team. First up is James Smith. James is our UK-based developed markets economist. James's segment is entitled Britain, Brexit, and the Long Road to Recovery. Following James will be Carsten Brzeski. Carsten is based in Germany and is our chief economist for the Eurozone and is global head of macro. Carsten's update is the pessimistically titled Europe, Too Good to Be True. Our third speaker is James Knightley. James is our chief international economist. He's kindly dialing in at dawn from New York. James's piece is titled US, Hints of a V, but Be Wary. And up last but not least is Chris Turner. Chris is our global head of markets, and Chris will walk us through what reflationary policies mean for the global markets. After our speakers, we'll open our lines for questions. So without further ado, let me hand you over to our first speaker, James.
Thanks a lot, Caroline. Hi, everybody. So I cover the UK economy. So I thought I'd kick off by just looking at where we are in terms of the fall in output we've seen since the virus came on. If you joined one of our last calls, we were kind of noting that, this crisis, whether it's in the UK or actually elsewhere as well, we've seen a drop in output, which is largely unprecedented, either in terms of the scale, but also at which the speed is kind of kicked in. And we've seen this come through in some of the official data over the past few weeks. The fall in economic activity in the UK is about 25% through March and April. And so, as I say, it goes without saying that's unlike anything we've seen before. And since then, the recovery has actually been pretty gradual, at least compared to some other places, as some of my colleagues will go on to talk about in a little while. Now, we've been looking at this Google mobility data, and it's proven to be quite a good proxy for what's been going on in the economy, how bad the size of the fall in economic output has been. And if we look at that, there's not been a huge recovery so far. We reckon probably through May, when the economy in the UK was gradually reopened, we probably saw a rebound of about 5 or 6% in terms of output. Probably something similar in June as well. We've had shops and so on, obviously, reopening. Now, that's obviously been a little bit slower than we've seen in other parts of Europe. So we think probably if we were to take a measure of where we are today, at the end of the second quarter, the economy is still probably about 15 to 20% smaller than it was before the virus really hit earlier this year. Now, clearly there's further ground to be made up in the next few weeks and months as a wider proportion of things get reopened, obviously from next weekend. But even then, like other places, we think the recovery is going to be pretty slow. Now, it's the same everywhere. It goes without saying that these kind of social distancing constraints, they're here for the foreseeable future, and they're going to make life a little bit difficult for some firms to return to profitable levels of operation. And you can kind of think of the likes of restaurants and other hospitality industries are good examples of that. And that in turn is raising concerns about where unemployment may be headed over the coming months. So far, the official unemployment rate has stayed fairly under control. But when the job retention scheme, the furlough scheme, begins to be adjusted from August, there's kind of concerns about whether, as firms adjust to this new environment, we see more job losses coming through. And that obviously poses bigger risks for the broader economy, particularly consumer spending, makes up the lion's share of UK growth. And I think you can divide shoppers into 2 main groups. Firstly, there's those that have already seen job losses, or actually probably more heavily those self-employed people who are no longer able to earn, or those that have been furloughed. And when we look at the data for the job retention scheme, we can see very clearly that those sectors with high levels of furloughing, high levels in terms of the number of employees furloughed, tend to have lower average levels of earnings, and also tend to be more insecure forms of employment as well. And of course, given that those consumers will typically have higher marginal propensity to spend, potentially suggests downside for spending over the coming months, particularly if, unfortunately, some of those jobs that have been so far furloughed are permanently lost. The other group, pool of consumers, which is probably bigger at the moment, are those that have been working through the pandemic but haven't, experienced a loss of income so far. So involuntary savings have gone up. Nobody's been able to spend anything because everything's been closed. But even here, I think there's a bit of a wariness. And we've seen this, last week the shops reopened. Retail footfall still substantially down pre-virus, and a number of the surveys showing that people are a bit wary about how safe it is to go out and enjoy sort of normal things again. And also there's awareness to think about job prospects further down the road. People will be questioning, if we do get that second wave, what does that mean for their own job prospects? So all of that suggests that the UK recovery will be pretty slow. We don't expect the economy to regain its lost ground probably until 2022 or 2023, like other places. But, of course, where the UK is not like other places is that we have Brexit, and that's really coming back to the fore again. And now it's all but certain the UK government won't seek an extension to that post-Brexit transition period. The deadline is next week, and it's not going to happen. So the game is really on to agree a deal that can be signed and implemented from the start of 2021. Now, is that possible? Well, there's little doubt that all of this, the coronavirus, has squeezed what was already a pretty tight timeline. A number of the civil servants who were working on trade have since been redeployed to cover the virus. Having said that, I think most people still reckon a free trade agreement is just about possible. That's still narrowly our base case as well. And I guess that's been given a bit of a boost by some of the recent comments from Boris Johnson that he's putting a tiger in the tank, intensifying talks through July. Now, in reality, adding more negotiating rounds probably isn't going to make the world of difference. And for all the talk from Boris Johnson that he wants to find the deal by the end of July, don't be surprised when we're all here again towards the end of October talking about a last-minute compromise. But compromise is possible. Certainly in some areas, fishing is a good example. But the real conundrum is whether Britain is prepared to accept that sort of ongoing alignment to EU state aid rules, and that's particularly coming to focus as the government looks to, aid the recovery from the virus. And it's very difficult to see how this gets resolved without the UK essentially accepting the EU's line of thinking. But over the last week or so, a potential fudge has come to light, and this would essentially be where the UK initially signs up to all these level playing commitments in exchange for a tariff-free deal to get something over the line. But over time, Britain would potentially seek to craft its own rules on these issues, and in turn, the EU would be expected to reintroduce tariffs. So in a sense, it's a kind of managed divergence process. Now, neither side is officially proposing this, but it was articulated in quite a lot of detail in The Spectator a week or so ago, which means essentially it's being unofficially touted by London. So the question is whether Brussels would be comfortable with that kind of compromise. And actually, various people are saying it's a very unusual situation to be in where a country would sign up to a free trade agreement that it's not really intending to stick to over subsequent years. So not clear whether we can kind of get an agreement on that. But whatever happens over the next few weeks and months, whether there's a deal or not, we'd always make the point that the economic impact is going to be pretty big. Tariffs, if there's no deal, will raise some additional costs, but the bulk of the cost and disruption will come from leaving the single market. And all the sort of customs clearance and potential delays that come with that. So I guess what that means is the UK is at higher risk of slipping into what we might call a W-shaped recovery. It doesn't necessarily mean we get another immediate hit to GDP like we've seen with COVID, but what we'll probably see is businesses don't have the capacity to fully prepare for these changes that could come next year. So there's a heightened risk to the jobs market, and that, again, could just kind of really slow the recovery. And there's a real fear, again, that SMEs probably be most affected by all of this. So all of this slow recovery, putting pressure back on the Bank of England again. And there's been a lot of talk about what they might do next over the coming months. Quite an interesting picture, actually, developing. Had a meeting last week, also various statements. And what we can see, perhaps, is that the bank isn't too keen on continually expanding its QE program. We did get a 100 billion expansion last week, but more importantly, the bank has signalled it's going to dramatically reduce the intensity of its purchases, how quickly it's buying gilts. Now, that kind of reflects that markets are a bit calmer, but it's also becoming increasingly clear that Andrew Bailey isn't a massive fan of a big central bank balance sheet. And he actually said last week he'd rather unwind its balance sheet before raising rates again. So that might sound a little bit academic some way down the road, but it may begin to sow the seeds of doubts about the bank's willingness to cushion the blow again in further episodes of market stress. But in turn, I guess that will also fuel the debate over negative interest rates. We've seen various comments from bank officials over recent weeks suggest they're not ruling it out. But I don't think it's their preferred path. I think it's fairly down the list of preferred tools. What they might actually do instead is look at their term funding scheme, which gives banks cheaper funding to encourage lending. That would probably be the first step before doing negative rates on a wider basis. So to sum all of that up, we're looking for, I'd say about 15 to 20% fall in GDP as we stand now, probably about a 9% overall fall in GDP this year, and a very slow recovery. And maybe that's a good point to pass over to the next speaker.
Thanks, James. Hi, everyone. Too good to be true. Europe. This is not a promotional talk sponsored by Brussels, but this is a bit of some food for thought. Obviously, not everything is good in Europe, but when you just think back some 6-8 weeks ago, we were looking at a eurozone, at Europe, which was highly divided on the fiscal response to the crisis, which was highly divided on the issue of solidarity across countries, and there was also the moment in which we had the German Constitutional Court's ruling on the ECB, so clearly also undermining the ECB's credibility and maybe even destroying future QE purchases. So compared to these 6 or 8 weeks ago, a lot has changed. I'll get back to this later. First, the economy. Similar to all the Western economies, we've had all the April data was horrible, was dreadful across the entire Eurozone. But what we do see, it seems to mark the end, at least, of the downswing. When you look at confidence indicators, whether it is the PMIs we just had this week, whether it is the German IFO, we really see what is unfolding right now, at least in May and June, is a nicely V-shaped, call this rebound, not a recovery. This also matches the Google mobility data that James already mentioned, that we also use for the European countries, where you do see that some, especially then the most advanced, so like Germany, like the Netherlands, are already back to some almost 90% of their, call this, social economic activity based on the Google mobility data that they had in January and February. Others, more the southern European countries, Spain, Italy, they are at around 70% of their activity levels back in January, February, but clearly the trend is up, and some are doing fine, which also means when you look at other more real-time data, currently the contraction in the first quarter could be something of between 6-7% Q-on-Q in the more advanced countries like Germany, but also on the other hand in the least advanced, some double-digit contraction in the second quarter. We'll know more obviously in a couple of weeks from now, but initially this looks like a nice V-shaped rebound. Not everything is fine, so we don't claim that this will continue as a V, because we also get a better impression of what the permanent damage currently is of the crisis, and this is mainly the increase in unemployment, the surge in short-term work schemes, plus the fact that contrary to the 2008-2009 recession, when the countries which had short-term work schemes already back then saw them almost exclusively in the manufacturing industry. This time around, short-term work schemes are spread across the entire economies, across all sectors, maybe except for the construction sector, which in my view also increases the risk that we will see a permanently higher unemployment rate over the next couple of years. So this clearly, and this obviously then would put a cap on any pace of the recovery. What is also not too good about the European economy is the fact that when you look at how are normally recoveries triggered after recession, traditionally a European recovery always starts with an increase in net exports. Net exports then spill over to domestic demand. This time around, as this shock is a global shock, as even Asia is still somehow struggling to gain more momentum, there can be doubts about whether really exports will be strong enough to kickstart the European recovery. So, Add to that there are also risks of a second wave that we're currently seeing actually in my home country, Germany, that there still is an increased risk of another trade war, or at least more protectionist rhetorics coming out of the U.S. now during the U.S. presidential campaign. You would think, hey, why is he talking about Europe too good to be true? There are, especially at the political front, some movements which are remarkable and which are structural, because there is a need for a domestic recovery, which means we need more fiscal stimulus. And when you look what happened now over the last 6 weeks, we saw an enormous U-turn at the European level. We now have a proposal for a European recovery fund. Yes, there are still diverging views, but there is no single country now doubting the need of such a recovery fund, and that is a huge difference. If you remember back last year, there was lots of opposition against a very mini Eurozone budget. So we're now talking about a Eurozone recovery fund of between 500 and 750 billion euro, where there is only the discussion, should this be loans, should this be grants, what will be the right mixture, but it will come. What we've also seen is that especially the German government has made a real U-turn on its role in Europe and its approach to fiscal policy. So forget about austerity measures. They have moved from austerity champion to big spender over the last 4 months. We talk about just a domestic fiscal stimulus in Germany of 35% of GDP. Cash out fiscal stimulus of these 35% GDP is up to 10% of GDP. There also seems to be a growing awareness of all European governments that this recovery money, that the new fiscal stimulus should be used to steer the direction of structural changes which are necessary. So when you look at all these programs, you will see that there is an enormous focus on sustainability, renewables, Green Deal. So this is not only just provide some income compensation, provide some, cash for clunkers schedules, but no, it is meant to really structurally change the economies. It's also a huge difference to what we've seen in the past. And also listening to all these policymakers, you also start to understand there won't be a quick return to austerity. So there is no one talking about this is a one-off and we need to return to surpluses next year or the year after. No, not at all. Rather expect another round, another wave of really cash out fiscal stimulus supporting the domestic part of the economy. Final point is the ECB. This entire, the fight between the German Constitutional Court and the ECB, there it also looks as if we will get a typical European muddling through compromise. I think now in an hour from now we'll get the minutes of the June meeting. My expectation would be that the ECB there will add some communication already to appease the German court, and also what I understood of some talks that at least next week the German Parliament is preparing some nice workaround to get rid of any pressure coming out of the German Constitutional Court. So this should also somehow disappear, so that the ECB then will be back in the game. We saw them already increasing the PEPP on 4th of June. From 750 billion to 1,350 billion euro, so that they are at least in the market until mid-2021. And when you look at all the communication, with a couple of interesting speeches this week from Philip Lane, the chief economist. So this does not sound similar to what we just heard about the Bank of England. So there are no attempts to reduce balance sheets. So they are really all in. They're just actually providing more information how positive their measures so far have been for inflation and on growth, so that I would expect the ECB to actually even increase the size of the PEPP program once again before the end of the year. So when you add all these things together, I think we might argue that good things are happening in Europe. Too good to be true. In the end, it always remains Europe, and there is always some disappointment around the corner. But for the time being, I think the there are good reasons to believe that at least this crisis will finally get somewhat more closer integration in Europe. That's it from my side. I would hand over then to James in the US.
Yeah, morning everyone. Well, in the US, the reopening is now happening in all of the states, and based on the same sort of Google mobility data that both James and Carsten have mentioned, it really is quite a varied reopening situation. So places like Montana and Idaho, where basically no one lives, if you look at the data that provided by Google, it suggests actually activity is above normal now, anywhere between sort of 5 and 10%. I guess that's the pent-up demand story, and people are sort of actively now out and about, having been locked up for a good number of weeks. Other states such as Mississippi, Tennessee, South Carolina, they're perhaps maybe 5% down on normal behavior to flat. So again, we're really returning to normality there. Other states like Arizona, Florida, Illinois, anywhere between down 18 and down 22% or so. But then where the big states, of course, like California, New Jersey, New York, where most people do actually indeed live, it's still down about a third. So you've got a really varied return coming through. And indeed here in New York, it is very partial still. So we had retail reopen on Monday, but to be honest, when I walk around Midtown and downtown, there's maybe a third of shops in New York that have actually bothered reopening. A good 20% are still actually boarded up, if you remember from those riots and the looting that we had that scarred, unfortunately, the protests that went on here. So it's still far returned from normality in New York. And indeed, restaurants have reopened, but you can only eat outside. So these entrepreneurial types have been putting bollards in the road, or basically plant pots, and putting chairs in the road. And so if you want to eat out, you can, but you've got a plant pot to protect you from an 18-wheeler truck. So again, it's not particularly attractive right now. So it's still a varied return, shall we say, right across the nation. Nonetheless, we have seen some much better activity coming through. Retail sales activity has rebounded, and there's been a lot of pent-up demand. And also, of course, in the US, we have to remember that they've handled the labour market situation very differently. Whereas we've had these furloughing schemes in Europe, the government has basically been paying private sector salaries. Well, in the US, we didn't do that. What we did is we've had mass unemployment. But those people on unemployment have actually received extended and far more generous benefits. So the average normal weekly unemployment benefits payment is about $350 a week normally. But of course, the federal government has stepped in and supported and boosted it by an additional $600 per week. And that continues until the end of July. So that means that the average unemployment benefits recipient is receiving the best part of $1,000 a week. And for many people, indeed the University of Chicago suggests 68% of unemployment benefit recipients are actually on higher incomes now than they were when they were working. So that's clearly supported income, it's supported sentiment, and through this moment, as retail is reopening, it's supporting spending as well. So that's clearly a good news story. Mortgage approvals for home purchases have surged high. We've had a really good run here. They're up about 18% year on year, having collapsed through March. So that's a good story. If you've got a strong housing market, that should boost spending in other related sectors such as furniture, home furnishing, garden supplies, building equipment as well. And also, of course, car sales. They've rebounded too. Some really good numbers coming through there. But again, I'll just caution that house buying and car buying, it tends to be actually by older people. The average age for a home buyer in America is 47. The average age for a car buyer is 50. So these people have probably been less impacted by the coronavirus impact on their employment and their incomes. They've also got better access to credits and are therefore better able to actually get that credit to buy a car and a house. So that's all a good, encouraging story. But the key question, as James and Carsten have suggested, is this just pent-up demand, or that could fade as reality kicks in, or is this a self-sustaining growth recovery? And on the 3 points I'd make regarding this situation, well, in the US, COVID-19 cases are clearly on the rise. Southern states are seeing some really big pickups right now, and of course that's led the tri-state area, so New York, New Jersey and Connecticut, to club together yesterday and announce that they're actually introducing a quarantine situation for anyone coming from those 8 southern states, or even just returning citizens from New York and et cetera, returning from Florida, for example. And if you are caught, you'll get a $1,000 fine. Repeat offenders get an $8,000 fine. So they're taking this pretty seriously, and they're putting money behind the monitoring of this. So the concern would be that could this be the catalyst for states to start taking these pickups in cases seriously, renewed lockdowns, or actually could consumers just vote with their feet? The uncertainty, the wariness of catching COVID-19 makes people not want to go out to restaurants or bars or retail in these southern states. So that's a key issue that we'll have to wait and see on. Secondly, the jobless claims numbers have been a little bit disappointing. Today, we're going to get jobless claims numbers in about 2 hours' time. The data we've had from states that publish ahead of time, Arizona and Pennsylvania, Wisconsin, have not been good. They've actually suggested we're starting to see a pickup in unemployment once more. Maybe that is because demand isn't there. You know, we had this initial pent-up wave, but now we're a few weeks in, and restaurants and retailers saying, well, actually, perhaps I'm not getting the sustainable recovery story coming through. And also this home-based data that we've all started watching, which provides timely daily updates on the small business sector, that suggested that employment is softening once more. So again, that's reasons for caution that, we have these people being brought back by employers. They've waited a few weeks to see the situation. They've realized that the new reality isn't what the old reality was, and as a result, they're right-sizing their workforces. So there's perhaps some, mixed news coming through on jobs, and I'd just be prepared today for perhaps a slight disappointment on the US numbers. And then finally, this unemployment benefit, this $600 boost provided by federal government that I mentioned, well, that ends on July the 31st. If it is not renewed, those millions of people who are out of work are going to see a massive drop in their incomes. And Donald Trump and various people in the Republicans are singing and cheering, saying this is great, we don't need to extend this has worked. Well, I'm just a little bit wary with some of these job numbers not looking quite as rosy, not looking quite as good as we've been hoping. That could be a situation that brings a reappraisal of the growth story. So there's 3 key points there that I've just emphasized when we're looking at how this recovery goes. I'm just a little bit wary that, again, despite yesterday's equity market dip, they're still very optimistic on the growth profile. Another thing that we're looking out for is the fiscal side. Another fiscal stimulus is likely because, of course, we're in an election year. It's focusing on new checks. The Donald Trump sent everyone, people earning less than $75,000, a $1,200 check. He's looking at reinstigating that idea, more infrastructure spending, but of course, that's going to take months to actually kick in. But we're also looking at more federal support for the states because the individual states aren't allowed to run deficits. And of course, state income taxes have collapsed. State spending has surged relating to COVID. So we're going to need to see effectively a bailout for the states. So we're looking for another $1 to $2 trillion of fiscal stimulus, which of course means a lot more borrowing as well. And given this election campaign, just briefly to summarize what the situation is, I mean, obviously you've probably seen the polls, but Donald Trump is not performing well. He's not had a good crisis over the last few weeks. His reaction to the Black Lives Matter marches has not gone down well. The Bolton book as well has further caused amusement amongst the situation. His poorly attended rally in Tulsa, and that means, he's now lagging in the polls anywhere between 8 and 14%. And of course, we've got to remember that the US election is not determined by overall voting, it's determined by the electoral colleges, the individual battles in the states. And given the swing states, there's only this election is going to be won in about 6 or 7 states at the most, more likely 5. But the key thing for Joe Biden is that he is well ahead in every single one of them. So at the moment, if it was today, Biden would win by a landslide. No doubt about that. The Economist had a model published yesterday saying there's an 87% chance that Biden wins. The predicted betting odds tracker suggests there's about a 60% chance Biden wins. That's the situation that we find ourselves. But you can't write Donald Trump off. 9 out of 10 Donald Trump voters from 2016 say they would vote for him again. He's got this really solid core support. And if he can get that out, anything is still possible. If he can get those people out to vote and the Democrats don't turn up, he could still very easily win. So it's still very, very close call despite what the opinion polling says. And as a result, Donald Trump is appealing to his base. We're seeing more talk about trade. We're seeing more talk about immigration bans and the visa bans as well. He's really appealing on his base. So he's fighting hard. And as I say, I wouldn't rule this out. The key differences, of course, just to finish, Donald Trump is looking at lower taxes, lower regulation, general indifference to environmental and energy transition, much more combative approach to international relations, probably dollar positive and equity market positive. And of course, this is actually probably one of the starkest contrasts in US politics for a number of years for elections. Joe Biden, we're looking at higher taxes, more focus on regulation for big tech and pharma. We're looking at taxes on corporates and environmental taxes coming through. As I said, that more focus on the environmental and the climate change situation, more willingness to work with international parties, and likely a weaker dollar and relatively weaker equities. Other than that, monetary policy, the Fed has made it clear, nothing happening for the next couple of years, so rates on hold. The one thing that they could do, of course, if yields start to rise on treasuries in response to this wave of issuance to fund all these fiscal bailouts and these fiscal stimulus, the Fed could conceivably do yield curve control, which is whereby they try and cap yields. They seem to be pulling back a little bit on that. And then right at the moment, with the US 10-year at 0.7%, there's very little need. But I think it is possible that we will hear something about this later in the year. And I'll stop there and hand over to Chris.
Thanks very much indeed, James. So when we were putting together ideas for this call a couple of weeks ago, I thought it would be good to focus on what reflationary set of policies, so loose fiscal policy, loose monetary policy, would mean for global markets. And at the time, equities and commodities were rallying, yield curves were steepening, and the dollar selling off. All the moves that you'd expect as investors return to recovery stories. But as events this week have shown, like conditions can quickly turn and second wave developments or tariff threats can quickly undermine sentiment. So where exactly are we now in the investment cycle? Well, I think the title of our monthly nicely sums up the situation in terms of hope returning, but huge challenges remaining. So we don't certainly have any unique insights on equity markets, but just suffice to say that US equities are trading at historically high price earnings ratios of 22 based on trailing earnings, just looking at that this morning, and sort of 5 and 10-year averages closer to sort of like the 18 PE kind of ratio. Supporting those high valuations may be the fact that central bankers are pinning risk-free rates to the floor, and that the TINA investment principle, or there is no alternative, is really winning out. Now, obviously, threats to the equity story come from the virus, but perhaps also, as James has mentioned, from US elections, where we'll watch whether the prospect of Joe Biden and greater business regulation will start to weigh. But I think what has been very helpful to global equities, and Carsten touched on this before, has been the EU recovery fund story. And if there is further progress here, I think that can provide a cushion to global equity markets. Now, with core yield curves, they briefly toyed, as we said, with reflationary steepening a couple of weeks ago. That situation has quickly reversed. That 2 to 10 US yield curve steepened about 20 basis points and has quickly handed that back. Our debt strategy team only see very limited steepening this year, not just because they're a pessimistic bunch, just kidding, but because aggressive central bank support, as James has mentioned, of the bond market is here to stay. So cheap financing of all this new debt is essential, and that's why our team only see US 10-year Treasury yields at 1% at year-end from, as James said, 70 basis points a day, and bond yields at minus 30. But I think what has clearly been a positive development are signs that the dollar funding squeeze has abated. And I find that most evident in the declining use of the Fed's dollar swaps line. So back in the middle of May, 14 central banks had outstanding dollar borrowing at the Fed of as much as $450 billion. Some out there felt that the very different nature of this crisis, the cheap borrowing rate and maybe the lower stigma of that borrowing would mean that those precautionary dollars will be held all year. But in fact, that dollar borrowing has already dropped back to $270 billion, a sign that accessing dollar funding in the wholesale funding markets has improved substantially, which is good news. And access to liquidity is still very much present in the credit market, where, as you probably all read, investment-grade issuance is surging this year. So total issuance in euros already stands near 500 billion euros. and looks on track to exceed last year's record of about 750 billion euros. But as our credit strategy team notes, credit spreads are still pricing a very benign outcome in terms of high yield default rates, somewhere like the 6% area. We think 10% is more likely, and so it's definitely a good idea to take advantage of these benign conditions while this window is open. Now, again, on the subject of access to liquidity, we know that emerging markets are enjoying a modest return from international investors. Between late January and the middle of May, some 105 billion of portfolio capital left emerging markets. This is according to the IIF in Washington, who track the data on a daily basis. Since then, since the middle of May, we've now seen 5 consecutive weeks of inflows. And if the events of 2009 are appropriate, and we can debate that, but that was a reflationary period, then we potentially could be looking at 3 to 6 month window of money being put back to work into emerging markets. So that brings us to foreign exchange markets and the dollar. Now, encouragingly, the broad dollar index has retraced the vast majority of its gains seen in March. That was a point when the dollar funding market seized up. Now, if our bias in terms of the title of the monthly lies towards the hope returns part, as opposed to the challenges ahead, then we think the set of policies out there should see a continuation of the risk-on, dollar-off FX regime that has been emerging over the last few weeks. That is our bias, and if we do get any progress on the EU Recovery Fund, I think that would certainly support the story. So we've got and we maintain a 120 euro-dollar target for year-end. In that environment, we think cable can be dragged above 130, largely on the dollar story. And we generally back the pro-cyclical and commodity currencies, some of which are still undervalued, to hold on to or to improve on their recent gains, despite the inevitable setbacks along the way.
Thank you all very much for joining, and thank you to our 4 speakers.